Gerard Cassidy of RBC Capital Markets saying negative loan loss provisions and stronger capital markets activity helped bolster results for the big banks. Gerard joining us now. Yes, they certainly did bolster the results. JP Morgan just posted a record quarterly profit, and yet the shares are down almost 2% ahead of the open. What do you make of that?
I think, Lisa, what we're seeing is the classic buy the rumor, sell the news. And as you know, the bank stocks year to date at the beginning of January have really outperformed the market as a whole by close to 12 percentage points. So I think there's just some classic profit taking. The outlook, though, remains, I think, very positive for the banks from what we saw today, particularly on credit, which has been the biggest issue for investors over the last 12 months with the bank stocks.
All right, let's parse into some of the details. Citigroup in particular gaining some notice today for a miss in its bond trading revenue. How much do you read into this, given the prominence of this business in their profit outlook?
There's always variability on the trading numbers quarter to quarter, and I think that's what we have to remember. So though it was slightly below expectations, I think when we look forward in 2021, not just for Citi, but for all of the large capital market players, the amount of liquidity that's been pumped into the marketplace continues. As you know, the Federal Reserve is still buying approximately $120 billion of securities every month. So that liquidity is going to have to be put to use, which will help all markets activities for all these players in 2021.
Wells Fargo in a league of its own, and not perhaps in a good way, with its shares underperforming, down now about 4.5% ahead of the open. And this comes as they disappointed. And they also didn't cut costs as quickly as people had previously expected. What do you think Wells Fargo needs to do to gain investor confidence?
Yes, the Wells numbers were disappointing. And I think part of the reason is everybody has been expecting a big restructuring announcement. We didn't see that in their release today or in their slide deck. And I think what people are really focused on is, when will they be released from some of these regulatory orders that they're very aggressively working to satisfy the regulators. The one in particular you might recall was the one from the Federal Reserve in, I think it was 2018, where the company has to have the asset cap. And so as a result of the asset cap, they're unable to grow, and that's really affecting their revenues. And obviously the other banks don't have those issues. And with the margins coming down the way they did, it's very tough to grow revenues when you can't grow your balance sheet.
With Wells Fargo yesterday, Reuters reporting that they're in talks with a couple of private equity companies to sell their more than $600 billion asset management arm. How much will that support its operations? Are you expecting that to go through and at a price that makes it worthwhile?
They are certainly refocused on trying to make this company as profitable as they can. And they've been spinning off a handful of different businesses. They sold their student loan portfolio recently. They've exited some direct finance business out of Canada. That was, I believe, announced yesterday. And so the asset management business that's been rumored for sale, I think is an area, it's an economies of scale business. As you know, the biggest asset managers are gaining market share. There's driving the fees down with the active managers under pressure from the passive managers. So it probably makes sense for Wells to exit the business since they may not have the economies of scale as a BlackRock or other competitors.
So let's just take a step back and view the banks as a wholesale group rather than individually. There's a question of how much control they have over their performance in the months and the year ahead, and how much it completely relies on the macroeconomic backdrop, how much yields rise or don't rise, and how much consumers can pay their loans. How clear a view are you getting from the conversations that you're hearing with analysts as well as on the calls that we've heard today on that front?
It's always been with banks, Lisa, they are products of their economy. And the economy is so important to the banks versus a pharmaceutical company like Pfizer. Obviously, the unemployment rate doesn't impact the vaccine that Pfizer is manufacturing, but it impacts, as you pointed out, the credit card payments if the unemployment rate continues to rise. So as we look into 21, it appears that the U.S. economy will be stronger because of these vaccines. And second, it appears now also that the yield curve is steepening. And if that yield curve continues to steepen, last night, President-elect Biden talked about another stimulus plan, possibly $1.9 trillion. And if you layer that on top of the recovery in the economy, and should inflation start to creep back into this economy, which we haven't seen for decades, of course, and that 10-year government bond yield goes higher, that's very positive for the banks. So the credit recovery is going to continue in 2021 due to the economy, and the yield curve possibly could steepen further, which would be very positive for the banks.